Hey, Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get sort of value or entertainment out of these videos, I ask you a thumbs up and subscribe. Questions, comments, put those below. Filming my last video here from Italy, so back to the regular schedule, regular studio next week. But wanted to cover some important data on the national housing data. So we're going to go through the national statistics, national figures, city by city, give you guys an idea of what's happening on the ground, as well as some important household balance sheet implications. And really the whole thesis is now finally starting to come together, and we're seeing that now in the data. So let's kind of jump into it. First and foremost, you have the national housing data coming out this week on the 15th of September, highlighting the August figures. So for the sixth consecutive month, housing sales on a seasonally adjusted basis declining. August sales figure is the worst in 3 years. Again, this is on a seasonally adjusted basis. So the housing figures, as we know, continue to be really, really weak. Greater Toronto, the largest housing market, as we talked about before, that's 20-year lows for the month of August. Greater Vancouver, the third lowest August in 20 years outside of 2008 and 2012. Obviously, we know those were incredibly weak years from an economic perspective. And so if you look at it, we now have national house prices continuing to roll over. So the home price index, which again is a seasonally adjusted, is a hedonically adjusted benchmark. It tends to lag, which is important when you're understanding, looking at all these data figures, when you're reading the media headlines. A lot of them will be talking about average house prices, and those can be extremely volatile. And then some of them will look at home price indexes. So it's important to understand what metric these media sources are referencing. And I think that the home price index tends to lag, but at least it gives us a smoother data point to look at. So a 1.7% month over month decline is actually a very large move for an index like this. And so peak to trough, we're now down 12% from the highs this year. As people say, well, 12%, but 12% on a national level is actually very, very large. It's very significant, especially in a short amount of time that we've had. And so if you actually look at this from a historical context, this is actually the single largest decline in the home price index since the index was created in 2005. So again, if you look at the chart, you'll see that in 2008, 2009, during the global financial crisis, Canadian house prices nationally declined by 9%. So we're now at 12%, and I think everyone can agree there's more downside to come in the very near term. So this is a historic correction that most Canadians have actually not yet lived through. And so just to give you some context, a lot of people say, okay, well, national house prices, they need to go back to at least pre-pandemic levels. To get to pre-pandemic levels, from my initial calculations here, you'd have to have the national house price index fall 38% from its highs. And so just to give you some more context, in the global financial crisis in the United States, the Case-Shiller index, which is the equivalent in the US, fell by 32% peak to trough. And it went from basically peaked in, I believe, in 2006 and slid all the way before bottoming sometime in 2011, 2012. So it's hard to say how it's all going to play out, but I think when we're looking at it and saying, well, if the US was 32%, we have to be there. You guys have to keep in mind that this was a global financial crisis. This was a systemic issue, basically blew up the entire banking system across the world. It was almost the end of the existing monetary system as it was. And in fact, it took us 10 years of zero negative interest rates and 10 plus years of quantitative easing, aka central bank money printing and involvement in the bond market, to basically keep keep the monetary system on life preservation. So to suggest that we're going to get there in Canada, I'm extremely skeptical, unless you're predicting basically another doomsday event where the banking system essentially blows up. Again, could happen, certainly not my base case, but 12%, I think more downside to come, clearly, as we still have what the markets are pricing in another 50 basis points of rate hikes from the Bank of Canada. But even if the rate hikes stop and pause, I think these rates are still too high. Canadians at these levels of house prices and levels of debt, 5% mortgage rates are simply too high for the economy to stomach. So again, keep in mind that moving forward, that these home price corrections and how much prices need to fall, just because they might not get to, say, 32% or 38% on a national basis doesn't mean you're not going to see that in certain pockets. And of course, we're all well aware that in certain suburban markets that had extreme amounts of froth, the work from home movement pushing prices up, we were already seeing 15 to 20% corrections in some of these very, very frothy suburban house markets. So could those get to 30, 35, 40% corrections? Absolutely. I think that's actually a reasonable probability. So we'll have to wait and see how that sort of shapes up. So there's going to be certain pockets that are going to see steeper corrections more so than others. But on a national basis, we're already through the steepest correction. I think there's more to come. But to say that, we're going to have 30+% corrections on a national basis remains to be seen. Because I think what's important to contextualize here is when we're looking at this by city, right? So if you look at it, we have various price corrections across the frothiest markets. And so you say, well, where's the highest house prices? Where's the most debt and most leverage? That's clearly in the GTA, which means the home price index peak to trough is now down 15%. Greater Vancouver, obviously another area with I would say very excessive valuations, down 7%. Ottawa down 11%, Montreal down 6%, and then you look at some of these cities that have been flat for really several decades. Calgary now down 2% peak to trough. So I don't think there's excessive valuations in some of these markets, but in others they're obviously more ripe and more vulnerable to these steeper corrections. So and again, just to kind of quickly touch on Calgary. Someone said, oh, they're next, they're going to blow up. It's like everywhere is going to blow up. And I go, well, I mean, that market is actually up 30% since 2007. So, over a 15-year period, that's 2% annualized growth, which is really actually below the rate of inflation, below the rate of wage inflation. So to suggest that there's bubbles in, say, Calgary, for example, I don't see that argument. To say that there's overvaluations and bubbles in the GTA and parts of the greater Vancouver market, fair assessment. But that's kind of how I'm looking at it now. So you can see as rates are going up, we are now seeing obviously the ramifications of that. The Bank of Canada is getting exactly what they want, which is a household balance sheet recession. So in fact, Canadian households in the third quarter lost nearly $1 trillion of household wealth. Again, we know wealth is somewhat fictitious because that's tied to their largest assets, which is real estate. But there was about $1 trillion of wealth that was evaporated off of household balance sheets. It was the steepest drawdown for any quarter going back to the data series, going back to, I believe it was the 1980s. So the household balance sheet recession is officially here. And so when you obviously feel less wealthy, you have less ability to tap into home equity to then use that to sort of pay off, say, other debts, to go out and buy new cars, new boats, etc. So the wealth effect is real. It's something it's something central banks talk about actively. And so one way to reduce inflation is to hit households where it matters most, which is their net worth. And so the bank's ultimate goal here to bring inflation down is to make everyone poor, everyone a little bit less wealthy, so you spend less into the economy, and that will obviously help to fix inflation over time. And so that's kind of what we're looking at, but there are ramifications of that. Again, this is not tied to just the housing market, as we can look and see. The Canadian labor market, for example, it just shed another 40,000 jobs last month. We've now seen 3 consecutive monthly declines in the labor market. And interestingly enough, a lot of this is actually hitting the construction market. The construction industry shed 38,000 jobs last month. It was the single largest 1-month decline since 2005. So we're starting to see the knock-on effects now slowly starting to filter through a lot of this data. And keep in mind, a lot of this data is backwards looking. So I think the data is going to continue to deteriorate moving forward. And so ultimately the question is, how high do rates continue to go? As we can clearly see, there's this impasse now in these housing markets, and people are asking, well, what do I do? What's next? How does this sort of shape up? And while I certainly don't have a crystal ball, all we have to do is look at the housing affordability index and clearly see that houses have become extremely unaffordable. Yes, we've seen price declines. Yes, this is the largest national house price decline on record, but rates are still so high that housing actually hasn't got any more affordable. And so how does this resolve itself? Either it's going to resolve itself through lower prices, or it's going to resolve itself through a lowering of rates. Maybe mortgage rates go from 5 down to 4.5 down to 4.2 as you get this economic recession and the bond market reprices economic growth. However, that it probably is going to take some time. I don't have rates falling in the next 1 to 2 months. So and it could be a combination of both. Maybe prices drop a bit and interest rates fall with it to hopefully relieve some of that affordability index. But at the end of the day, you are at this impasse, and this is what the data is showing us, that there is this problem. And so what we're seeing, feet on the ground is, yeah, sales are incredibly weak. Buyers are wanting to wait. But at the end of the day, inventory is still pretty low because the inventory levels were picked dry over the last couple of years. So you had a record low inventory base coming into this year. It's going to take some time to build that inventory up. However, what we're seeing in parts of these markets in the GTA and in Greater Vancouver, we had 20-year lows and new listings. The sellers are kind of holding off. So you have a lot of people that bought, 10, 15, 20 years ago that have tons and tons of equity. They don't like the prices today, and they're opting just to hold still and sit pat. And so there's kind of a bit of a tug of war. And so the people that are looking for deals today, there's really not a whole lot of inventory. And so you're seeing actually a lot of the inventory that's on the market today is you still have sellers pricing things at February, March, April pricing, and they're not actually that realistic about selling. So they'll sit there on the market for 2 or 3 months with no price reduction and very little negotiation room on the pricing. You only have a small cohort of the market that's actually willing to trade at what the offers are coming in at. So we have a very, very illiquid market, and we're actually seeing we're seeing very large discrepancies in pricing, which means that, okay, you can see the odd house is maybe even getting more than one offer. I think there's a cohort of buyers that I think are actually overpaying for some houses. And you go, wow, that house traded at such a high price. Like, don't these buyers know what the market conditions are? And then you see other ones where you go, oh man, that seller, like, he dropped his price 3 times in a month and took a lowball offer and basically reset that neighborhood. So because when you have 20 plus year lows in housing sales in parts of these markets, price discovery becomes extremely challenging. And so this is kind of the environment that buyers and sellers are operating in. And it's almost makes it difficult on a realtor and agent's business to try to price things, because ultimately you have to sort of price it at a certain level where you think it should be, give yourself that bit of room for negotiating, and see how the market digests it. And again, if you've got no offers, 5 weeks on the market, chances are you're too high and you got to cut your price. But there's only a certain cohort of sellers that are also open to engaging in that. And there's a lot of unrealistic people that I think we'll probably start to see the reduced pricing over time, but it might take them 3, 4, 5 months to actually reduce their price. And then they're one step behind the market. Yeah, they reduce their price, but they reduce it by a couple percent. But during that time that they've reduced, the market has continued to fall lower. So keep in mind, we're in this very illiquid market. The housing market, the data, I think, is continuing to deteriorate. I think that inflation, again, my opinion, is going to come down lower. And people, just to get onto this last little bit, I had a lot of comments from last week's video calling that, hey, this is the 1980s. Interest rates are going to continue to skyrocket. Remember when inflation was this high? We had rates at 10, 15+%. I just need to preface everything. Again, you guys can go and do your own research, but we have to remember that the 1980s government debt to GDP was at 50%, give or take, was about 50% of GDP. Today, it's at about 110% of GDP. So you got the government balance sheets, the sovereign balance sheets, which are not in the same shape as they were in the 1980s. You can't compare those. The second more important one is corporate balance sheets. In particular, you can go household balance sheets. Household debt to GDP in the 80s was around 60% of GDP, 60% of GDP. Today, it's at about 110% of GDP. So you've basically got a doubling of household debt to GDP. So this is not the 1980s. This is not your granddaddy's inflation of the 80s. These are much different environments. And so I would argue that the rate movements that we've seen, which is a doubling in 6 months, is actually it's today's equivalent of what your granddaddy might have gone through in the 1980s. I would say that is our equivalent based simply on debt to GDP levels. Again, we've talked about it on the show, but global debt to GDP is at 365%. Okay, so we've seen more than doubling of debt levels. And you can use the same simple analysis, right? You go back to the 1980s, I would say, okay, well, yeah, mortgage rates got up to 15, 18%, but house prices were a couple $100,000. That same house today is $1.8 million. And so when the rate moves from 2 to 5, it makes a real difference. And we've talked about it already on the show. If you have $1 million mortgage today on a variable rate product, you've seen your monthly payments increase year to date. Your monthly payments have increased by a minimum of $1,500 per month. So that is a material difference on household balance sheets. And that's why we're seeing the reduction in wealth, $1 trillion wiped off. That's why we're seeing the job layoffs, because that's going to trickle through into consumer spending. All you have to do, guys, go Google FedEx news. Go look at the latest report from FedEx. Huge miss on earnings. Stock price down 15% on the day. Basically talking about a global recession, that their shipping volume is down tremendously because the global economy, the consumer, is incredibly weak, and FedEx serves some of the largest businesses. And so when their shipping volumes drop, it really shows you, I think, real-time data, not the lagging data that the government puts out, but real-time data is the consumer is in a much worse position than I think the data is showing. But that will slowly filter through over the coming months. So that's my thoughts. Could be wrong, could be right. Let's see. See you next week.